All right, hello everyone. I wanted just to take some time here with Guy, portfolio manager, and talk about why we build out portfolios mainly with individual stocks versus mutual funds. We've talked often about having better risk management with it, better tax management, and being able to be more kind of efficient and agile in the market and the economy that we're in. So, Guy, if you want to hit on those points on why you use those individual stocks normally to build it out, and then when we need to use ETFs, I'll let you kind of take it away.
Yeah, absolutely. Yeah, so any type of pooled securities like mutual funds or ETFs, they do serve very important, they do serve a good function because they provide diversification, especially for lower balanced accounts. And then besides that, they're pretty crucial within qualified plans and when it's a little more passive and you need to make sure that people are getting their diversification and providing that level of protection. But once the assets have built to a certain enough large, basically once the assets have gotten large enough, you can start to convert over to individual securities to be able to get that diversification. But once you switch to that mode, we find that you can actually increase the risk adjusted return because you can, in a lot of cases, better manage the downside risk. And part of the reason is because just the way that the funds are kind of modeled from growing their business standpoint. Oftentimes, they're kind of competing with each other within the same market spaces, but not working individually with people and being able to kind of talk through market volatility. What they're trying to do is outperform each other. And it's usually within good market environments because that's when people tend to do their shopping. When markets are bad, people aren't usually doing their mutual fund comparison to try and see which fund they should be going into versus another. They're either kind of not looking and holding on, or hopefully not panic selling, but a lot do, or panic selling and going into cash. But either way, they're not choosing the new mutual fund in a poor market environment. Where they do that is when markets are doing fine and they're happy to look and see how did mine do versus this other one. So the mutual funds are incentivized to try and outperform each other on the upside, which means they're not trying to minimize downside risk because it's very hard to do both of those. When you convert over to individual stocks, you can better manage that downside risk, because you can be putting in alerts for certain stop protections, things like that, to be strategically raising certain amounts of cash or getting out of certain sectors versus others given a particular type of market circumstance. That can be very hard to do when you're in a large cap mutual fund or something like that. And then the other side, on the ETF side, the ETFs are oftentimes very indexed based. And when you look right now, indexes have, if you're looking at cap weighted indexes, they have gotten more concentrated than they have been in a very long time. Because of the effect of the Magnificent Seven, which a lot of people probably heard about from last year in 2023, the cap weighted S&P 500 market index, seven names, those Magnificent Seven, make up about 30% of the index currently. An index that is supposed to be representative of the top 500 companies in the US, 30% of it is made up of those seven names. So the concentration has gotten very much higher within that ETF, and a lot of other market indexes are even worse than that. Now, if you look at the difference, because you can also go to an equal weighted ETF, versus a cap weighted ETF. But the difference is when you kind of diversify it out, where all 500 names have an equal weighting, that's if you look at the S&P 500 equal weighted, the difference in performance last year was that equal weight was up about 12% versus the cap weighted being up 24%. So the point of me kind of pointing that out is if we're utilizing individual securities, we can be managing to more of an equal weight target, and meaning that we don't have any one security that's going to be making up 7, 8% of the portfolio. They can all be kind of keeping within that equal weight, but we also aren't going to spread that out among 500 different names. If even if it's spread out between 30 to 50 names, there's going to be a bit more conviction in those choices and better participation in a good market like we had last year. So that's why we feel that with individual securities, you can be increasing the risk adjusted return, by better participating with good markets, but then putting more emphasis on downside protection when we're seeing poor markets.
And can you just maybe define risk adjusted returns and how you would say that to that? If I say that to somebody, sometimes they don't know exactly what that means. So if you want to
Yeah.
just a little on.
So basically, in a nutshell, the risk adjusted return is trying to hit a certain level of return, with with minimizing the amount of risk. So basically, taking less risk to get the same type of return, hopefully. That's
Makes sense.
and sometimes with a lot of our clients, they might be willing to give up some of the upside, whereas, maybe a market index is up, like I said, 24%, in 2023, but they're happy to get their 20%. So they're participating with the upside, but on the flip side, we're going to be minimizing the downside risk. So if the market's down, they're not going to be down 30% like the market might be down, So that's basically increasing the risk adjusted return, is being able to participate with market growth while minimizing the downside risk in poor markets.
And then one other thought that I had that I know we talk about is why a mutual fund or an ETF can't do some of that too, is because they do have to manage the prospectus. So as you're saying, overweighting to a certain stock or company or sector, like we use 2020 as a great example, right? Because when that happened, you did not want to be in, the health, let's just say the travel industry at that time, right? Hospitality. Yet Amazon, healthcare industries, Zoom, all those companies were poised to do well, and they all took a hit initially because they were, when you sell out, whether it was you, if you still hold your fund, you didn't, but there was other people that are selling out of those funds and they have to sell equal. They can't say, I'm going to hold on to Amazon because it's going to be good and get rid of XYZ, right? They have to sell, based on what their prospectus is, correct?
Absolutely. Yep. So there is more, not as much flexibility with many of the funds because, like you said, they're so large and they're managing to a style or prospectus, like you mentioned, rather than to an individual. They're not having conversations with the individuals. They're managing to the prospectus that's already been put out there. So when a 2020 hits and the market's changing very quickly, the funds can't go out and change the prospectus to then navigate those volatile markets.
Yeah.
Versus in our individual stock portfolios, we can manage a little more to the market circumstances, and that's inherently how they're supposed to be built. So 2020 was a perfect example that, after some of the initial reaction, and it was very effective to, have some stops go off at late February, early March of 2020. But then it even got to a point where, because of that index dynamic, like you mentioned, people that were just basically not selling individual companies, because you can't do that when you're holding a mutual fund or an index. It's just you're selling the market, because you're worried about the market, so you're selling the fund, you're selling the market. But within that fund, absolutely, they all had to sell their Amazon shares. And at a point we looked at it, and this was very common conversations we were having that with people that were worried about it. And they said, all right, well, you worried about owning Amazon in this environment? And most people would say, no, it probably makes a lot of sense to be buying Amazon right now, since everyone's got to stay at home and everyone's going to be using Amazon now. But the even more perfect example was, there's a company called Medtronics, which in middle of March, Medtronics for the year was down 30%. And what is Medtronic's main business? It's producing hospital supplies, and in particular ventilators. So that was another position that we were able to enter and buy when it was that, with some of the cash we had raised, and when we discussed it with most clients, they said, yeah, that's probably a good business to be buying right now. And it ended up being a very good business. So it is, it increases the flexibility to be able to take what the market has given you and also, kind of adjusting things when we're seeing different market environments.
Right, and I think that's a good time to use because everybody can relate to that, very easily. And then the last hit we'll hit on a little bit is if it's money that's not in an IRA or a Roth, then tax efficiency becomes important because, if you have a lot of growth, but you didn't manage taxes and you end up paying a bunch of taxes when you want to, sell the fund via capital gains tax, you almost handcuff yourself and your returns were not your actual returns. So I know that individually we can manage those by using individual holdings, you manage taxes. So if you want to just hit on that quick and then we'll wrap it up.
Oh yeah. I mean, that's one of the biggest caveats, especially with mutual funds, because right off the bat, a mutual fund is going to often have a capital gain distribution that comes out each year, and that's reflective of the sales that were forced within the fund through the course of the year. Whether the manager could proactively decide to be selling it because it's a good time to be selling the stock. Usually, that's what happens in good markets, but what a lot of people often see in bad markets is when people are leaving the fund, the manager has cash redemptions he or she has to come up with. So that means they have to be selling stocks whether or not they like it to make sure that they're sending out the cash that is leaving the fund. And oftentimes that means selling positions that they may have held for a long time and they're realizing gains. So at the end of the year, those gains get distributed out proportionally to the fund holders within the fund. So oftentimes you might have a really bad year in 2020 and or 2022 and actually have a cap gain distribution at the end of the day that you're going to have to pay because other people were selling and forcing the sale of certain securities. So besides that obvious fact of not being very not being very tax efficient, in general, mutual funds and ETFs, you're pooled in with all the different securities. So, in given different types of markets, going back to 2020 again, the market overall ended up having a pretty good year. The S&P 500 was up about 16% come year end, but not all sectors did. Energy was down, and energy stocks were down between 30 and 60% in some cases. So, if you had a portfolio of individual stocks and you actually had some individual energy securities, you could be selling those to be taking a tax loss, and doing a swap, buying other ones back to regain the exposure. You can't do that once when you're in an ETF or a mutual fund. You can't carve out what sections have done poorly that year because it's all grouped together. So that's one of the advantages of going more to an individual stock portfolio because you can be much more tax efficient with the tax swaps that you do in each year. And then additionally, besides the cap gain distributions that we mentioned already, it's just you can be better managing year in, year out to what you're seeing with your actual growth and taking losses where you can be, within the individual stocks.
Makes sense. So, all right. So those are all the reasons why, again, just to recap, using individual stocks versus mutual fund gives you more agility to move around based on what's going on in the current markets, to better plan for tax efficiency and to better risk manage, which means, trying to get, a good return with less risk, right? Or the same return with less risk. Or sometimes maybe a little less return for even less risk. It depends on what's most important to you, but risk management, tax management, and being agile and what's going on are some of the main reasons why it's important to build it out with stocks versus mutual funds, using ETFs when the accounts are maybe too small to use stocks, or for positions that maybe we don't want that big of a exposure to or something like that, right? So anyway, so thanks for that. We can always go on to any more in detailed questions, what's going on right now, what are the portfolio and what's holding, and talk through it on your individual account. But thanks, Guy, for sharing today.
All right. Thanks, Michelle.
All right.